It is not unusual for most investors to be sitting in a downtrend wondering, how come I didn't sell up here someplace? This is a good way to learn how to make or understand why the relevancy of candlestick reversal signals are very important for knowing the direction of a market trend. For example, when the stochastics are in the overbought area, we can see that there was some selling pressure. A bearish harami gap down. They started back up again, but indecisively. The candlestick investor realizes that this signal right here, a doji followed by a bearish engulfing signal, and closing below the T-line, is the final nail in the coffin that tells you the bears have taken control. Even though there was signs of buying, there is one parameter that the bulls could not do. They could not close back up above the T-line. So simple logic tells us that if we see a candlestick reversal signal, especially a strong reversal signal like the bearish left-right combo and a close below the T-line, no matter what we're hoping might happen as far as being long, has to be assumed that the simple statistics show that if you see a candlestick sell signal and a close below the T-line, you're in a downtrend until you see a candlestick buy signal and a close back up above the T-line, and or a candlestick reversal signal moving a good distance away from the T-line, watching to see if they're going to bounce it back up to the T-line. Notice what happened today in the hard selling where the Dow was off another 400 points during the day. Look at the distance from here to the T-line. Very simple statistical analysis or candlestick analysis tells us if we're that far away from the T-line, start watching your 10-minute chart to see if the buying comes back in. Now, is this a reversal signal? We don't know. We're getting close to the oversold area, and we're doing a hammer signal. That far away from the T-line. There's always the prospect that maybe you're going to have a day or two of a bounce back up to the T-line. But the analysis of the overall market doesn't take very long. You can use the other indexes to coincide with each other index. For example, the NASDAQ gapped down, getting close to the oversold area, and it held at the 50, but more importantly, notice the color of the candle. It opened here, closed here, creating a green candle, but more specifically, it told investors or candlestick investors that there was buying going on eventually after the open. So there was bulls in this market. So even though the NASDAQ was down 32 points on the day, there was buying going on. And was this buying relevant? Once again, made the 50-day moving average a visual support level, telling us there was the prospects that maybe there'll be a bounce. So as a trader or a short-term trader, that's relevant in the sense that if you were short positions and you're starting to see buying coming in, you start covering your short positions, and maybe you trade for a day or two on the long side. The qualifications or the quantifying of candlestick reversal signals and patterns can be accentuated by the fact that if you see a strong reversal signal, like our bullish left-right combo, followed by a trend kicker signal, told us we could be buying BHVN today on positive trading because of the strength of the signal. And this was even in light of the fact that the market initially sold off hard. If it traded positive, we knew what type of pattern was setting up. Here's kind of your J-hook pattern. That same analysis was applied to holding on to our recommendation of ZIXI. You can see the pattern setup. This is what we call the classic pattern. Fry pan bottom, J-hook pattern, then the big price move, and then notice how the consolidation never got back to where they could close it below the open of this big gap up. the J-hook pattern is in progress, or our analysis that the 45-degree, which is a high probability trade setup, is in progress. Once again, the pattern was working positive even though the market was trading off significantly during the day. The benefit of candlestick analysis is where it opens and where it closes creates signals and patterns that allow the candlestick investor to see with much more clarity which direction a price is moving. Going back to the very basic analysis of prices do not move based upon fundamentals. Prices move based upon the perception of fundamentals. And candlestick analysis is merely the graphic depiction of what's going on in investor sentiment. That's it. We'll see you in the chat rooms.